Hello friends, this is my first video about the stock market where I am giving basic knowledge to advance. In the coming videos I will post more videos about this. Stock market knowledge. What is equity? In finance, equity is ownership of assets that may have debts or other liabilities attached to them. Equity is measured for accounting purposes by subtracting liabilities from the value of an asset. For example, if someone owns a car worth 10,000 rupees and owes 4,000 rupees on the loan used to buy the car, then the difference of 6,000 rupees is equity. Equity can apply to a single asset, such as a car or house, or to an entire business. A business that needs to start up or expand its operations can sell its equity in order to raise cash that does not have to be repaid on a set schedule. When liabilities attached to an asset exceed its value, the difference is called a deficit and the asset is informally said to be underwater or upside down. In government finance or other non-profit settings, equity is known as net position or net assets. Key features of equity share. Payment to equity shares is after meeting all other claims or shares. These shares are not redeemable during the life of the company. To make the things easier, check the key features of equity shares. Equity shares remain with the company until the company terminates itself. Equity shareholders have right to vote during the election of the management. The shareholders have a residual claim on the company's assets. The liability of the equity shareholder limits to the value of their shares. At the time of liquidation, the equity shareholders get what remains at last. First, creditors and preference shareholders are paid for their claims. Benefits of equity share. Equity shares offering many benefits from the perspectives of investment and financing. Here are the major advantages of equity. There are no charges over the assets involved to issue equity shares. It is a permanent and stable source of raising capital. In the case of profit, shareholders gain an increase in dividend. The value of the shares also gets appreciation in the case of profits. Equity shares offer many benefits to companies as well as investors. But, there are certain cons as well. Disadvantages of equity share. The pros and cons of equity shares are from the perspectives of an investor and a company. Here are some major cons of equity shares from both the views. The cost of issuing equity shares is quite high. Not every company can afford it unless it has sound financial status. When equity financing is in excess, it results in overcapitalization, which means funds are more than need. Funds may not be put to use in a proper way. The control of the company results in dilution. During the low market scenario, equity shares go down. The market value gets down. Dividends on equity are only on earnings of the company after tax deductions. The cost of equity capital is higher than that of preference shares and debentures. Hence, the expectations of the shareholders are also high in the same context. Thank you for watching this video. If you want to know more about stock market related concepts, please write a comments. I will try bring that videos as soon as possible.